Hello and welcome to a very special edition of Indianomics because we have good news to share. The GDP data for the fourth quarter and for the full year FY26 has turned out to be a blockbuster. For the fourth quarter itself, we have a GDP reading of 7.8% versus the CNBC TV18 poll of 7.3%. For the full year, the reading is 7.7% against a CNBC poll of 7.5%. The skeptics in the market was because the month of March saw the war break out in West Asia, but that does not appear to have had any impact at all on the pace of growth of the fourth quarter, at least. We will have to see what the first quarter of FY27 holds for us. But with Q4 beating the economists, beating the street estimates so handsomely, we must see some reaction in the stock markets on Monday. But to parse the numbers more carefully and give us the key takeaways, I'm joined by a bunch of top-notch economists. Aditi Nair, the chief economist at ICRA, HDFC Bank's vice president and senior economist, Sakshi Gupta and Rajni Sinha, the chief economist at Care Edge Ratings, join us. Ladies, what a pleasure to have all three of you. It's a full house, all four of us here to dissect the economy and its performance in the fourth quarter. Let me start with you, Sakshi. What are the standout components of the fourth quarter GDP for you?
Right, Lata, as you rightly said, I mean, clearly a very, very positive surprise, a very good day, both in terms of policy and data that has come out. Of course, this is a good 50 basis points higher than what we were estimating for the fourth quarter. So a couple of points, on the details. One of the things is that if you look at the demand side indicators, clearly consumption, investment, as well as valuables are three categories where growth has been much stronger than what we had anticipated and what we were seeing in the previous quarters, right? So clearly it is signaling that at least on the consumer side, there was a lot of momentum in the economy that continued post the third quarter. And I would anticipate that some of this also spills into Q1, which is something we are already picking up from a number of high frequency indicators. Secondly, I think on the if you look at the supply side data, I think again across the sectors, if I look at mining, services, manufacturing, construction, all indicators have come in much higher, and therefore the impact of the conflict doesn't seem to have played out in a very big way, at least for the fourth quarter.
Point. I mean, we should, of course, discuss the war angle, but per se, let me read the elements that really stand out. One of the largest employer segments outside of agriculture is the trade, hotels, transport and communication and broadcasting segment. That's grown by a whopping 12.5%. I can't remember when I last saw a number as good as that. And it's beating only by a shade another very employment-heavy sector like construction, which has grown at 8.4%. Of course, finance is the other big sector, which has grown by 10.4%. And there again, real estate and ownership of dwelling, professional services also come in. That growing at 10.4% also shows a wide swathe of people who could have benefited. And of course, you have manufacturing sector also growing by a reasonable 7.3%. But what is eye-popping clearly is services when it comes to the supply side, trade, hotels, transport and communication, and finance, real estate and ownership of dwelling, professional services. Both of them growing by 12.4 and 10.4 is an excellent number. And as Sakshi was saying, if you looked at it from the expenditure side, what stands out is gross fixed capital formation. Capital formation or investment has grown by 10.8%. I mean, again, I can't remember when I last saw a double digit on capex. We've been doing well on capex, but when we say well, we mean normally 7.5%. But 10.8 is really taking it beyond the realm of expectation. Aditi, I think I blurted out all the things that stood out for me. Now, with this kind of a number, will you start rethinking FY27 numbers?
Thank you, Lata. Well, definitely, today it's always nice as an economist when growth surprises you on the upside. You don't mind the fact that your forecast has gone awry. And I think all of us in the market will be very happy that this resilience has come through the Q4 GDP numbers. Definitely, we will relook at what the FY27 forecast should be. In fact, even the MPC in the morning had put in a number which was only slightly lower than their previous forecast and a bit higher than the number that we've been working with. So just to give you context, before the West Asia crisis started, we were projecting GDP growth for FY27 at 7.1%. From there, we moved to bringing in a baseline scenario of crude oil being $85 per barrel. And at that, we thought that Indian GDP growth could slip to 6.5%. Then we gave up 85 and we moved to 95. And at $95 per barrel, we've been kind of working with GDP expanding by 6.2% in FY27. So now I think we definitely will look at some of these numbers and perhaps bring in some upside to our 6.2% number. I just want to give a little bit of a caveat that, the services sector is what has caused the beat in the initial estimate from the CSO today as compared to our estimate.
Yes.
And I'm just wondering if there is any element about, the informal sector that we thought would have been more hard hit, particularly things like the LPG shortages, etc., which were there in March. And if there is a possibility that later data covering the informal sector is actually going to pair this estimate a little bit. So that's something we're going to think about and then look at what is an appropriate upward revision to our GDP forecast for FY27.
No, that's a fair point that there will be revisions because the third quarter has also gotten revised fairly significantly, right? I think it's gotten revised from 7.8 to 8%. I mean, we were not prepared for that 8% growth even in the third quarter. That higher revision also kind of makes you want to sit up. Now the combined growth for the second half works out to 7.9, which is almost 8%. That's fairly strong. But let me come to Rajni. Rajni, first, what stands out for you? And secondly, can the base be the negative? I mean, as it is, we are expecting that the GVA of companies will be hit because of raw material costs. And so we should expect lower value addition in the current and next quarter. Add to that a larger base. So do you think we should be a little skeptical about FY27?
Lata, yes, the number has been a big positive surprise. And I would say what stands out is, like you mentioned, services sector growth. It was much higher than what we were expecting. And not just in the fourth quarter, otherwise also, if you see in the last few quarters, in fact, last few years, we have been seeing that service sector has been very resilient. And that's what has been supporting India's growth. And on the expenditure side, I would say what stands out is the investment growth. And interestingly, the investment growth is good in the fourth quarter. But if you look at the center's capex as well as the state's capex from the fiscal side, the numbers were not looking great. So does this also indicate that the private capex has supported this high growth number, which would again be a positive thing because fourth quarter, while only the last month got impacted by the West Asia crisis, but overall, even sentiments have not been great in the economy. Business sentiments have been impacted by all these uncertainties. So in that sense, investment growth number being so healthy is a big positive surprise. What to expect for next year? Next year, definitely, we are going to see the full impact of the West Asia crisis. But from what we have been seeing, the data for the last few quarters, the economy is showing much more resilience than what most of us were expecting. So in that sense, probably the impact of West Asia crisis may not be as severe as we have been fearing. Our projection for next year is 6.7%. Which is now, a little higher than what RBI has said. But that is assuming crude oil at around average of 90. But if it turns out higher, say $100 for the year, then our expectation is around 6.5%, and it can go lower if crude oil price is even higher than that. So as you can see from our projections, we are not very, very pessimistic on the impact of West Asia crisis.
Okay.
Having You know, the aspect that you have highlighted, base effect, yes, that will also play a role because, yeah, growth has turned out higher than what we were expecting. And more so, this whole uncertainty, we still don't know for how long this crisis is going to linger.
I take your point. Rajni, I take your point that all those will come crowding in. But the other factor that might impact the Q1 or FY27 could be government finances. I mean, both tax collections and the fact that there is a much larger payout on fertilizer subsidy, food subsidy, and fuel subsidy may hamstring the capital formation. And you also alluded to the capital formation. 10.8% is the capital formation in the fourth quarter. The previous quarter was 8.2 and the previous is 8.4. So we've had a fairly strong full year capital formation, which, not so much states, but definitely center. So Aditi, would that get impacted? Can that be the one that drags, or at least sobers down? Drags is a strong word because we are sitting in such a pretty position. Will it sober down the Q1 GDP, the current quarter?
Lata, in fact, GOI's capex contracted by 23% in Q4. So that's, a little odd compared to the GFCF growth number that we've got. And I think, again, this is something that, we need to keep in mind in terms of potential revisions later on.
Okay.
Now, coming to Government of India's finances, basically our sort of back of the envelope calculation, keeping in mind all of the revenue hit that could be there and the expenditure that could go up. We think that there is likely to be a 30 bips slippage in the fiscal deficit to GDP. And of course, there are some changes related to the nominal GDP that's coming in as the base. So we're now looking at a fiscal deficit of 4.7% of GDP for FY27. So yes, there will be some constraining of discretionary spending, both revenue and capex, to absorb the higher fertilizer and fuel subsidies, etc., LPG subsidies, as well as the hit to taxes and the non-tax revenues of Government of India, whether it's excise, dividends from the OMCs, overall corporate tax collections, etc. But that's not a huge hit. I mean, we're looking at a modest hit right now.
Okay, fair enough. Sakshi, where does this leave the RBI actually? When I saw the inflation forecast for the second quarter at 5.1, the last forecast they had was 4.4. They've raised the July, August, September forecast by 70 basis points, which gave me a fear that, if you want to be ahead of the curve, you have to hike as early as August. And now that the growth is so good, do you think that gives them the elbow room to be, kind of ahead of the curve, or at least with the curve on inflation? Would you expect a rate hike in August is the small question.
Yeah, I mean, look, Lata, I don't think that I'm expecting a rate hike in the August policy. There is a simple reason for that. One, I mean, of course, the Q4 growth number is very strong. But as we've discussed, I think a lot of the impact will start coming in Q1 and then possibly Q2, right? And there's going to be a base effect, etc. Moreover, there's El Nino and what that does to, demand conditions as well as inflation. The second thing is that if you look at RBI's projections, I think that, and some of the commentary that came out today, they are saying that, look, we know that this is a supply, shock and there is an inflationary shock, but we are also looking at whether that's having a second round or more generalized impact on inflation, forward-looking inflation, as well as inflation expectation. So at this point, I think I'm betting on the fact that August will still be wait and watch, both on inflation and growth. And then October could be, a live policy where I'm expecting that, we could start expecting a rate hike from the central bank.
Okay. Very quickly, Rajni, what are you expecting in terms of hits? I mean, 6.7% forecast is what you told me for FY27. That is even better than what the Reserve Bank is expecting. They are sitting at 6.6, which they revealed today. There will be a hit to government capex as well. You could have a hit to consumption because of the El Nino. What makes you so confident of the current year?
So Lata, like I said, what you see from the past data, the economy has been showing more resilience. So we are more confident on the services sector growth. Even exports, if you see, it has impacted very adversely. Specifically, our services exports have been doing very well. So that's another thing that gives me confidence. As you see, the investment data, again, that looks good. And that's in spite of the fact that Center's capex has not been good for the last fourth quarter, and even the state's capex has not been great. But still, overall, GFCF has recorded good growth. The consumption growth, private final consumption expenditure growth has also been healthy,
Yes.
though that would get impacted to some extent by higher inflation that we are expecting for FY27. But overall, I don't see a very strong dent to consumption expenditure also.
Okay. You may be having the last laugh because the economy is surprising on the upside, surprising skeptics on the upside. We have to take a commercial break. But when I come back, a rapid fire in terms of what you are expecting on growth, on inflation, on rates and rupee, all that coming after the break. Welcome back to a special Indianomics on the blockbuster Q4 GDP numbers for FY26 that was just announced by the MoSPI. The GDP number for the fourth quarter has come in at 7.8% compared to market estimates, the CNBC TV18 poll of 7.3. Likewise, the full year estimates, our poll said 7.5, but the actual number has come in at 7.7, giving us 3 continuous years of over 7% growth. In the new series, after the new GDP series came in, the blockbuster number, the highlights of the blockbuster numbers for Q4 itself is trade, hotels, transport and communication, an important labor-intensive sector that's grown by 12.5%, finance, real estate, dwelling and IT professional services, that's grown at 10.4%, and we've got fairly decent performances coming even from construction, 8.4, manufacturing, 7.3. So practically all sectors have done well, except perhaps mining, which one should expect with 1 month of the war hitting the economy. Likewise, from the demand side as well, we've got a fairly decent gross fixed capital formation number of 10.8% for the fourth quarter. I've been speaking with economist Aditi Nair of ICRA, Sakshi Gupta of HDFC and Rajani Sinha of CARE. Ladies, thank you very much for your patience. I want to know your forecast now for the current year. I already got Rajani's or CARE's forecast for FY27 at 6.7%. Sakshi, what are you going with?
So we are estimating 6.5% for GDP growth.
Okay, and do you think you may be changing it, looking at the resilience?
Not at this point. I think we are we were at about 6.7, 6.8, but we brought it down to 6.5. Yeah.
Okay. Yeah, we have time to wait. We're barely 2 months into the year. Yours, Aditi?
We were at 6.2 and we'll still be sub 6.5. We won't go above 6.5.
Yeah, okay, sorry, you told me it is 6.2. Well, Sakshi, I just wanted to ask you, after the bunch of steps announced for banks by the Reserve Bank, the banks are likely to get cheaper funding from ECBs now, and they're likely to get cheaper funding from FCNR deposits. The impact was seen today itself in certificates of deposit, CD rates, falling by about 20 to 25 basis points. The cost of deposits is therefore likely to come, cost of funding is therefore likely to come down for banks a bit. Don't you expect that to reflect in the financial sector number itself in the GDP and more generally in terms of, economic activity?
Right. No, look, Lata, I mean, you are talking about, the cost of funding and deposit, but I think that story has to match up with what's happening on the credit side as well, right? So, I mean, we've seen a lot of momentum in terms of credit growth over the last couple of months, and that's continued well into April and May for various, reasons. And there has been, this widening gap between credit and deposit that we are seeing across the system, which is also getting picked up in, if you look at the transmission across, fresh rupee deposits or lending rates. I mean, that's kind of picking that up. So my estimation is that, yes, I mean, I am expecting credit growth to remain strong. Of course, with the measures around today, we will see an improvement also on the, liability side. But the gap between the two perhaps will continue, going forward.
Okay. Okay, I just thought the gap may get a little smaller because of some funding advantages from the steps announced by the Reserve Bank. Okay, may I get a round of when are you all expecting and how many rate hikes this year? Sakshi, you said no rate hike in August. When is your first hike and how many this year?
So cumulative 50 basis points and first likely in October.
Rajni?
So mine is also similar. Last quarter, I'm expecting around 25 to 50 basis point.
Okay. Aditi?
25 bips in the Q3.
Okay, and only one. You're not expecting more than that. Okay. Well, that's modest, and the governor didn't exactly seem too hawkish when it came to rates. They are going to wait for the second round of impact of inflation in case there is a wage price spiral. So you may well be right that they may not want to hurry it up in August. Final question and on the rupee. Sakshi, do you see the rupee having seen its worst for now? Let's only talk about the coming quarter. Up until September 30th, do you think we don't revisit 96?
Right. I think that we have perhaps seen the worst. I think that over the coming quarter, depending on the quantum of flows that we get from the measures that are announced today, I do definitely see an appreciation bias for the rupee. I'm looking out for 93 perhaps. I mean, it's difficult to call a, particular level, but perhaps we are going to move towards that 93 level in the upcoming quarter if we are able to get enough, flows.
Oh, that's a huge one if it's 93, but you're not the only one telling us that. The street chatter was also between 93 and 94 for this quarter. Just a word on fiscal deficit from the two rating agency economists. You have to keep it very short. Aditi, your fiscal deficit number?
4.7%, but no concomitant increase in borrowing because there's a lot of cash which has come through because of higher small savings.
And Rajni?
So we have estimated the fiscal cost at 0.5% of GDP, but the fiscal deficit may not increase by that much because we could.
But it is more than 4.3.
Yes.
All right, fine. I'm sorry I'm out of time. The chances of fiscal deficit slipping are still there, but it may not be very big. Let's see if the economy is as good as it is depicted in the fourth quarter, then perhaps the tax flows also will not be impacted too much in the current year and the current quarter. We should know those details by the 15th of September. Thank you very much, Sakshi, Aditi and Rajni for joining me. The verdict from the economists is also that the fourth quarter was stunning, but the Q1 and the current year may see a bit of a moderation in the pace of growth. That's it on this edition of Indianomics. Thank you for watching.